All right. Good morning, everybody. Happy Thursday. I know many of you are celebrating Passover, celebrating Holy Thursday today, and I want to thank you for taking the time to join us for the inaugural Espresso with Carlo. And for those of you that might imagine, where are we? I do have my espresso cup. You can't see it, but it is there. So I'm having an espresso. I hope you're all safe. You know, there's no reason to sugarcoat what's been going on. It has been a very challenging time, obviously, for people's personal lives, their health, but something we can't gloss over is people's professional lives and people's economic lives and paying bills, and whether it's paying your staff at work, paying the rent, paying the mortgage, keeping the lights on in the office. We've heard from our members, and I want to thank our members who are on this morning, that it's been a rough period. And while we get through the recovery piece of this, the health piece of it, keeping everybody safe and healthy, we cannot not think about the future, because the economy will get back. People will come back to work. We will get back on crowded subways. We will get back in traffic jams. By the way, I think we're all looking forward to those things right now. But in the meantime, it's really in all of our interest to keep your businesses, your employees, the ownership sound financially. And we could not think of anyone better than Grassi and team to really join us for our first webinar series this morning and talk about next steps and how do we get through the coming weeks and months, but importantly, how do we understand what the federal government is putting out there, what type of opportunities there are for businesses, the payroll protection. I mean, there's so many things. I am not an accountant. I'm the furthest thing from it. And that's why we have professionals that you see here. So I'll come back later to take some questions. But without further ado, let me welcome Lou Grassi. Lou is a dear friend, a board member on our foundation. Lou is the CEO and founding partner of Grassi Accountants. And Lou, I'm going to turn it over to you. You obviously have a stellar team on here, and the floor is yours, Lou.
You know, thank you, Carlo. We really appreciate you giving us this opportunity. I know we're the inaugural webinar for Espresso with Carlo, so we're honored to be in that position. I really want to thank everyone and hope everyone that's on this call is safe and their families are safe as well. One of the things I mentioned to Carlo is we have a tremendous affinity to the construction and related industries. And as a consequence, we thought it would be a great idea to allow our fellow members to understand a little better about some of the provisions of the CARES Act. The CARES Act was signed on the 27th of March, and obviously it had many provisions in it for both businesses and opportunities. But one of the provisions that everyone seems to be talking about, and Carlo, you mentioned it before, is the Payroll Protection Program, provision of the Act, which gives those industry members that employ less than 500 people a loan that ultimately comes from the Small Business Administration. But it has a provision in it that allows it, or a good chunk of it, to be forgiven if in fact dollars are spent on employing people, paying rent and utilities, etc. As many of you know, there's been a lot of confusion regarding a number of the provisions of the Act. And there's been a lot of backups at a lot of the banks that each of our members are going into the individual bank sites, and every bank seems to have its own individual provisions. which is creating a lot of confusion in the business opportunity, in the business community. I'm sorry. However, one of the things that is probably great for a lot of our members that are developers and real estate owners is there's many provisions in the act that basically make it almost a mini tax reform bill, because it corrects a lot of the issues in the Tax Act of 2017. And it has many provisions in there for individuals as well. So this morning, I have with me Carlo Oliveri, who heads up our construction niche at the firm. I have Rob Brewer, who heads up our architectural and engineering practice at Grassi and Company. And in addition, I have Jeff Agranoff, who heads up our HR consulting group at the firm. We've all been very busy over the last week, obviously helping our clients navigate the PPP provisions of the Act, and obviously can bring forward a lot of those experiences to you today, and that's what we hope to do. If you have any questions, obviously our presentation will be sent out to you. Just reach out to us. Obviously, the new way of doing business is everyone is doing business remotely, and our world has changed in a very short period of time. But I, like Carlo, believe that, great days are right around the corner, and we will get through this like we've gotten through everything else. And this industry will be the industry that leads us out of this. So with no further ado, I'll turn it over to Carlo Oliveri.
Thanks, Lou. Carlo, thank you, and to the Building Congress for having me.
Carlo.
Appreciate it. Just to add on to Lou's comments, if we look back at any recent economic disaster that's hit this state and this city specifically, construction has been the guiding light. So Sandy, 9/11, things before and after. This is the industry that's resilient. This is the industry that builds the city and will continue to build this city. So I second those comments that we will get through this. I'm going to spend a few minutes, and I know you've heard a lot about different loan programs and grant options out there. I'm going to spend a few minutes talking about the two big ones that have gotten a lot of traction in the media lately. That's the Economic Injury Disaster Loan Program, the EIDL, and obviously the Payroll Protection Program provisions of the CARES Act. So let's start with the first one, the EIDL. This is an SBA loan program that's in place. It's been in place prior to CARES. If it seems familiar in terms of terminology, that's because you probably heard it when Hurricane Sandy hit. It was very popular when Sandy hit us, and again, it's starting to get some traction out there as well. This is a working capital loan that's targeted at small businesses, certain cooperatives, tribal businesses, ESOPs, independent contractors, and sole proprietors. So really, when you think of a small business, that pure definition, this is who that program is defined, is intended for. Under 500 employees, and you could apply for up to $2 million of relief under this program. Very, very competitive interest rates, 3.75 for the small business, and they're looking for repayment terms over 30 years. So it's if that sounds you, it's because it's very similar to a mortgage. These funds are intended to be used to pay fixed debts, payroll, accounts payable, and other operating expenses that a small business, and in our case, a construction company, cannot pay or sustain that would normally have paid if a disaster never happened. This is not intended to replace lost sales, profits, or to expand your operation. It's to keep the lights on and the engine running. Any business that has been affected by a disaster can occur for this. For our standpoint, under COVID-19, the applicants must have suffered and have to show they suffered a substantial economic injury from a result of the pandemic here. Part of that is proving that your business operates in a declared disaster area, which if you went on the SBA's website today, typed in New York, I'd be hard pressed to find an area of New York that has not been impacted by this. There are personal guarantees for the loan over 200 as well. If you're looking for 200 or less, you're out of the personal guarantee game, so you don't have to worry about that. It does waive the requirement that you have to show that you can get equity or lending ability elsewhere. That was another nice provision CARES built into there. There's some collateral requirements if the EID loan is over $25,000, and you do have to demonstrate the ability to repay the loan over that term we just discussed. These come with some very basic filing requirements. It's not through the bank, this is through the U.S. Treasury, the SBA. So all that work, all that applying is done through the SBA's website as well. The biggest difference between this loan and I'm gonna call them, I can't say P3 because I think that terminology is being used elsewhere in construction, but the PPP loan, the biggest difference here is that the PPP can be eligible for forgiveness, which is a real nice feature of that. So let's shift gears in the few minutes I have left and talk about the PPPs. This really has been built into the section as a grant in disguise, right? The plan was for the government to help small businesses, again, that definition of 500 or less employees for the purposes of this conversation, cover payroll costs for the next 8 weeks. The formula is based on a permitted average payroll cost at 2.5 times. There's been a lot of discussion and a lot of debate over what falls into that bucket of average payroll costs. Finally, the treasurer came out with some clarification, and it's cash compensation, gross wages, very clear. Earlier reiteration said you're taking out federal withholding taxes and FICA. It is all in gross compensation, capped, keyword capped, at $100,000 per employee. So if you have a run of 10 employees, all making $150,000, you're capping their salaries at $100,000 for this calculation. You are then adding any benefits to that. Medical, vision, dental, whatever those benefits are, those then get added to the $100,000. The average is that divided by 12, and that becomes your average monthly base to apply 2.5% to figure out your loan amount.
Carl, I want to interrupt one minute.
Please.
This is a critical piece of this discussion, and the question I know I've gotten asked dozens of times. So I want you to run through that again. So it is
Absolutely.
up to 100,000 per employee. That does not include any benefits, correct?
When we first read the regs, when the regs first came out after the president signed them, they were very vague. And a lot of CPA firms, the AICPA, one of our governing bodies, wrote a white paper and came out and said, it's $100,000 all in. When the FAQ came out from the Treasury late Monday night, around 11:45, I read it, it was clear that it said $100,000 of wages plus benefits. So an example, Carlo, if I'm getting paid $200,000 and I have $25,000 of benefits, I'm in at 100 of salary plus 25 of benefits.
And one last question, because I've gotten this question as well. If the firm, let's say you're making the 200,000 for an example, if the firm still wants to pay you 200, can they pay you that other 100, or does the person have to go to 100 now if you're in this PPP?
So that's another great question. Your salary is your salary. So if I'm kept on through this economic period, you're going to pay me what you're normally going to pay me, unless you have an option to take me down to 75% of my salary if you choose to do so in the forgiveness terms. But for the calculation itself, the pure calculation to go to the SBA and say, I need money, please help me, you're capped at 100.
Got it. Okay, perfect. Thank you.
So thank you, Carl. And you're right. That's been a point of contention with a lot of companies, and we have to get that cleared up. So I hope that clears it up. I think the real big thing here is, and what everybody wants to talk about is, what could I use this money for and how do I get forgiveness? Payroll costs, which we've discussed, is obviously an allowable use of this money. Any costs related to those benefits, group health coverage as well. Certain mortgage interests could apply. The big ticket items, though, outside of payroll are going to be rent and certain utilities. The idea here is that the employees need a roof over their heads to work. So that's where that half a point factor comes in the 2.5 to cover those associated overhead expenses as well. If you decide not to forgiveness and you decide to term this out, it's a 2-year, 1% working capital loan, which is very competitive for any industry as well. Spend a quick few minutes on forgiveness because I think that's the piece everybody's interested in. The beauty of this loan is you have an opportunity to turn it into a grant. So tax-free money. This is free money at the end of the day if you do things the right way. You have to use the funds for those qualified payroll costs and certain rent and utilities as discussed. The key here is you have to bring your headcount back up to pre-corona levels. And when Jeff Agranoff takes over from me in a moment, he'll talk about some of those key dates for you. But those pre-corona employment levels are key towards forgiveness. So if you get funding today, you have 8 weeks to use the money on qualified payroll costs and bring your employment levels up to start qualifying for forgiveness. If you don't bring your headcount back up or you miss that June 30th date, your forgiveness options start to reduce on a headcount by headcount basis. There's a lot of confusion there. Unfortunately, we'll have a little time to work through it, but just keep that in mind. The keys here is bringing the headcount back up to pre-corona levels, June 30th, having everybody back on payroll, and it has to be headcount. It doesn't need to be the same people. So if you let go of Carl for whatever reason during this and you want to replace my function with Carlo, you have the opportunity to do that as long as it's a full-time equivalent for a full-time equivalent. No less than 75% of the wage at the wages. I'm sorry, I cut somebody off.
No, I think that's an important thing because I've been asked that question as well. I just want to remind our listeners and our viewers, and I see a couple of questions that we'll get to in a little bit, but go to the Q&A, type your question in, and then we'll answer questions at the end.
Thank you. I'm going to turn it over to Jeff Agranoff, who's going to talk about the CARES Act and some of these changes in the employee regulations as it relates to your businesses as well.
Okay. Thank you, Carl. We appreciate it. So you also touched upon, obviously, some of the headcount provisions and kind of the workforce management issues that come out with the loan programs. We definitely want to address that in some of the Q&A. You covered some of the key dates. Obviously, there's a couple key measurement periods depending on what your headcount looked like in your business. And those two main headcounts are February 15th of 2019 to June 30th of 2019. And an alternative measurement period is January 1st of 2020 to February 29th of 2020. You obviously want to cover pick the lower of the two headcount measurement periods to compare where you are on that June 30th of 2020 headcount. This way, as you said before, it maximizes that forgiveness. There's also the important part is using those payroll costs during that loan period. So when that loan is funded, you really want to make sure, as you said, you use at least 75% of those costs on payroll costs, and you could actually go above that. A lot of people don't realize that, especially since, remember, the loan calculation often is based on 2.5 times your average payroll cost, which you're only getting 8 weeks to spend. So you're getting 2.5 months and only getting 2 months to spend that money. So a lot of strategy, a lot of projections, making sure you can bring your people back, or if you're bringing less people back, how to pay them more, maybe give them additional compensation. There's going to be a lot of strategy, a lot of tips and tricks, a lot of management of the workforce and your compensation around that that needs to be done with inside your organization, and to bring an advisor in like Grassi to help and assist to make sure we maximize that forgiveness of that. Another component we want to just add that was related to the CARES Act, but was in a prior legislation, was the Families First Coronavirus Response Act. It's often referred to as the FFCRA. That was passed a little over 2 weeks ago, but it became implemented on April 1st of this year. And there's been some confusion also on what are those leave programs, how do they relate to any of the state leave programs that are out there, particularly New York passed its own legislation on March 18th that became active right away. So as a quick overview, the FFCRA created two main leave programs. One was called the Emergency FMLA program, even though it shares the same name as FMLA that we typically know, it's sort of unrelated to it, is this is a paid program. It does offer job protected leave for 12 weeks, similar to the FMLA we all know. But what it does is for people that have people that have a child and they are a guardian or caretaker of that child who's 18 or under, they are given up to 12 weeks of job protected leave. The first 2 weeks can be unpaid, and the next 10 weeks are paid at 2/3 of their normal salary, up to a $200 per day cap. That's $10,000 in aggregate. That's the only way they're eligible. There's been some confusion about how do people are eligible for that emergency FMLA versus some of the other leave programs. The other one that's out there, it's a little broader, it's the emergency sick leave. Again, another federal program that was instituted on April 1st. That has more levels of eligibility. There's two where you become eligible at up to $511 a day. That's somebody's full salary, whatever they make, on average up to $511 per day. Those two eligibility components are: one, if the employee has contracted the virus themselves, they're eligible. Or two, if an employee is under doctor's orders or under orders from you as the employer because they've had direct contact with someone they've worked with who've had the virus, they will qualify in those two ways for full salary up to $511 a day. The two other components, which would be up to $200 per day, but again, full salary up to that part, not 2/3, is if the person is a guardian or caretaker of a child, they're also eligible through this program. And if they are taking care of a family or relative who's contracted a virus or under doctor's orders, they're also eligible $200 a day. This program is only valid for up to 80 hours, which traditionally would be 2 weeks, but they actually do this one by hours. The emergency FMLA is by weeks. So there are some differences between the program. If an employee qualifies for the eligibility for either program, you do need to let them take it. The good news for you as an employer, you are reimbursed dollar for dollar on the wages, not on the benefits or anything else above the wages, but at least on the wages. And the mechanism for doing that is you as the employer will take a tax credit on the following quarter's payroll quarterly tax filing on the employer's side of the Social Security tax. So you'll be able to, get that credit for the wages, pay yourself back for that. So at least you do not have to worry about carrying that payroll long-term other than the cash outlay that's there now. We have a lot of construction organizations that have made changes with their employees, terminations, furloughs before April 1st, which if you obviously didn't have the work was a smart move. If someone is not an active employee, so if they've already been terminated or furloughed, they cannot sign up for either of these federal leave programs. If they are currently active, they can. Obviously, any changes you make now, once you make that change and move them to a terminated or a furloughed status, they also again are not eligible. When work comes back and you bring them back, and let's say on April 30th they come back from work because jobs have restarted, then they can qualify again. And again, you at least will be reimbursed for those programs on the federal level. New York State implemented an emergency sick leave on March 18th. It was sort of a bridge to get New York workers through a sick leave program until the federal program became valid on May 1st. The federal program now does take precedence. The problem with the state program is it did not necessarily give employers direct reimbursement for it. Also gave additional sick days based on the size of the companies. It's not that valid right now, given that the federal law, again, is superseding, what that state is offering as well. But again, any of your employees you had before April 1st could have been eligible through that program. And again, unfortunately, there was not a complete direct reimbursement to the employer for people taking that time. Both the federal and the New York State programs, those days offered of paid leave are above and beyond the sick or PTO time that you give your employees. So you would not reduce that from their account unless they specifically said they wanted to use their own time, which of course, they're entitled to do. We've also had questions recently, and the DOL has updated that you can take both leave programs, the federal ones, on an intermittent basis. So as long as the employer is in agreement that it works within the workforce that they have and the job that they have, they can be eligible to take intermittent leave if the employer agrees to that, but is not required by that employer. So those are even a couple updates from when the law passed originally April 1st. Again, very important to manage that headcount, especially if you're going to take a PPP loan where that forgiveness is very key. And we're happy to address any questions you have about strategic planning when we get to the Q&A portion.
Great, thanks, Jeff. And we are getting lots of questions. And I just want to say thank you because as this is going on, the participants are growing. So this is really exciting.
Thanks. Next, we have Rob Brewer, who heads up our architectural and engineering group.
Good morning, everyone. Yes, good morning. I wanted to give an update on how the A&E firms are doing. Carlo asked us to do that. So how are the A&E firms feeling? The first thing to ask the question is, what industry segment are they in? If they're in the infrastructure segment, which is mostly essential, I think they're feeling pretty good. But I think Carlo will have some new guidance shortly. Commercial office building space is non-essential, so they may not be doing so well if they're in that space. Affordable housing, mostly essential. Healthcare, mostly essential. And higher ed, non-essential. So I think if they answer that question, which segments are they involved in, we'll tell you how they're feeling. I wanted to go over an observation as to the segments and how this pandemic may change the future. I was recently involved in a panel discussion for the Commercial Observer titled The Design and Sustainability Innovations Behind Higher Ed's Construction Boom. On the panel, we had individuals from the construction side as well as individuals from the university side and also from DASNY. We got into the effect of the pandemic on the design and construction of higher ed facilities. What may change after the pandemic? Will there be less desire for colleges to design new facilities, more online learning? And there will be more repurposing of existing buildings due to underutilization of existing buildings already. Will there be a change in the design to be better prepared for things like this? Quarantine areas, new forms of communication campus-wide. What if they are in the healthcare space? Will that segment expand further? And if you're in the commercial office building space, will we see a lot less money going into expanding office space with more people working from home? This all tells us that the pandemic may change the makeup of the work for the A&E firms going forward, as well as construction firms. I'm also involved in a weekly A&E crisis roundtable run by June Jewell, the author of Find the Lost Dollars. She is also a partner of ours in helping our firms train their future leaders. And we have firms from all over the country addressing issues on a weekly basis and how they're dealing with those issues. Some of the highlights from our last few talks with those A&E firms nationally. One is helping employees work at home and cope with stress. Do you have new policies set up? Do you have a detailed communication policy? Do you make sure employees have somewhere to go for questions? How are you managing documents, new business hours, home office setups and equipment challenges? Timesheets, resource scheduling, remote supervision and training. A best practice in this area would be to have weekly staff meetings with video and also to pay a lot of attention to morale. Number two, maintaining cash flow and financial stability. A best practice here would be to set up a policy to call customers to get timeline on collections and do a detailed cash flow budget for the next 6 to 8 weeks. The third item discussed was ensuring projects keep running. A best practice here would be to move some team members that were on non-essential projects to the essential ones and get those projects done faster. Retaining your best clients. Best practice, be in constant contact and ask them if there are other services you can do for them during this time. Finding new opportunities for business during the crisis. Look at the past lost opportunities and go back to those. It may be that there is an opportunity to get work from a lost bid. Reinventing your marketing and services to meet demand. It's a great time to reinvent your marketing strategy and to look at your service offerings. So what's the long-term economic and financial considerations after this pandemic? A best practice would be to think hard about succession. Look long-term and who are the future leaders of your firm? And make sure those are the ones that will help you rebound from this crisis and make sure the firm is successful for the future. I hope to answer any questions you have after our further discussion. Thank you.
I think it's probably a good time to go into some questions, Carlo. You're muted, Carlo.
Okay. Thank you, guys, and really, I think very, very important. So question one, and I'm just going to go through them as they come in. Does the
Beautiful.
PPP cover union benefits paid by the employer?
Yes, union benefits are in. They're part of it. The political action, the PAC and the education funds are out though. So the welfare, the medical, they're all in.
Okay, great. What about union benefits for retirement, et cetera, that the employer, hold on. Okay, union benefits for retirement that employer contributes to the union. This is considered retirement.
That's no different than the employer's match of a defined benefit or 401k or profit share. So yes, that would be in as well. It's clear
Right.
that benefits are in.
Right. One question, somebody asked this question, but I know we've heard it before. To qualify for the PPP, we know it's salaries, but you can also include rent.
No. So
No.
you could use the proceeds for rent, not exceed 75% is the magic number.
75%.
Yeah.
Mhm. Yes.
But the base calculation is on payroll costs. The regs are very clear. That's
Yes.
they're spending the money's for 2 weeks of payroll. So that's a 2 in the formula. That half a point, that factor, that's to cover the overhead piece of it as well. So you go.
Okay, so you can include it to cover rent.
Yes.
Yes.
Yeah.
What about utilities?
Again, in order to get the loan, Carlo, it's basically the only factor is your payroll cost. Again,
Got
subject to the $100,000 limitation,
Right.
cash payroll. And then you multiply that times 2.5. And as Jeff and Carl said before, that's really to cover 10 weeks. 8 weeks of that should be payroll. And then the other portion is your other expenses that you incur, like rent, utilities, interest on debt that was in place on February 15th, et cetera, et cetera. But that part can't be greater than 70. The payroll part has to be at least 75%.
Got it. Good. Have they defined how to calculate pre-corona employment levels?
Jeff, you want to handle that?
Sure. So as we mentioned, there's 2 main measurement periods that are going to be used to count the employment levels. Again, if we're talking about the forgiveness component of it, you would choose which one works better for you. The 2 are February 15th of 19 through June 30th of 19, and then January 1st of 2020 to February 29th of 2020. You would want to choose, of course, the lower of the 2, so that by June 30th of 2020, you'd be able to be at the same level where you're at one of those 2 measurement days.
Great.
One of the things that, Carlo, just one thing to clear up on is during that time frame, to start with that base, you need to look at your average employees. So you look at each pay period that covers that period that Jeff just mentioned, and then you see what your average number of employees or FTEs were there during that period of time. So it's
Great.
employees.
Correct, Rob. Yeah.
One question, someone asked it, but we've heard it from a few people. Do we expect that there will be some sort of confirmation once your application is in, or are they so overwhelmed that they're not even saying, we've gotten your application and we'll get back to you?
Carlo, this is Rob. Yesterday we had our the first one I was involved with that actually got funded.
Wow, that's
I'll
great.
tell you that story. So this was actually a prospect engineering firm that came to us, needed help to put the application together. We did that on Saturday. He ended up filing for it on Saturday morning. And yesterday he received an email with a document from the SBA, an actual loan document. When he signed it, sent it back, he was funded about an hour and a half later, wired to his account for $1.5 million.
Wow.
So it can come quickly, but we have a lot of horror stories with other banks that they're not even open for business or it's taking so much longer. But the money will come, as soon as you have all the information in, and if you're with that's obviously making sure that things are getting done. So it's happening. It's happening already.
Right. And Rob, I think we're seeing sometimes the larger banks we think might take longer, where that client obviously was with a smaller credit union. And at the same time, it could be the advantage of a lot of organizations in the group here to maybe not get the proceeds right away, especially if workers can't come back to work right now.
Somebody asked, can you please restate the time periods to compare the pre-coronavirus numbers?
Yeah.
Okay. Yeah, sure. The measurement periods, again, you'd have a choice of two. One is February 15th, 2019 through June 30th of 2019. The other is January 1st of 2020 to February 29th of 2020. And as Rob just shared, it's the average FTE during that period. So again, you would want to choose the lower of the two periods so that it would be measured against that.
Right. If a firm is forced to furlough now, excuse me, to protect the company's financial position, but brings back the furloughed employees before June 30th, does that jeopardize potential forgiveness of the PPP loan amount? So you furlough now, you bring them back June 15th. Does that hurt the forgiveness?
Yeah, I mean, it does hurt the forgiveness. You're bringing them back by June 30th, which that protects at least the headcount provision of it. The issue with bringing them back on June 15th is depending on when their loan was funded, they won't have the people back to use the payroll cost for, their compensation. So we believe most loans will be funded anywhere from 2 to 6 weeks. Again, in the case that Rob shared, the person got funded almost immediately, but we believe 2 to 6 weeks will be the time period from larger banks will get funded. So if your loan gets funded later in April, early in May, and you're not bringing people back until the end of June, you'll meet the requirement to get them back by June 30th, but you're not going to be able to have them there for the 8 weeks where you're spending the money on the payroll costs. So that ultimately will bring down the forgiveness significantly.
Got it. While we're talking about furlough, we've been asked this question many times. Can you give kind of a big picture, if you can, overview on what does furloughing an employee mean, and what do you do?
Okay. Well, I think a question's come up a lot. When work stops, what do you do with an employee? And most organizations are either furloughing or terminating people, but we've seen some that just don't even create a status. The number one recommendation we have is don't leave an employee out there with no status. You need to either furlough or terminate them, have some type of job action. And of course, it's always ideal to put it in writing to protect you as the employer. But it also protects the employee because in both actions, they are eligible to qualify for unemployment, and they're going to need something in writing saying they've been terminated or furloughed. And Carlo, at a high level, the main issue really, a lot of it is around benefits on a furlough versus termination. When you furlough someone, it's supposed to be a temporary layoff or job pause. It's really only supposed to be intended for a 30, maybe up to a 60-day period. The one issue that can happen with a furlough is you're really keeping that person under active medical and other, insurances like dental, medical, maybe vision, and they need to have that insurance paid by the employer because there will be no mechanism for the employee to pay for that insurance while they're on a furlough. So if you as the employer are willing to lay out that money and pay for the total cost, including the employee share if they pay a share, then you could do a furlough. Generally, furloughs are accepted for 30 days by insurance carriers. Most of them have said they'll do it for 60 days. If you're going to go over 60 days, you need to talk to your insurance carrier to make sure they'll let you keep that person on that insurance. What you're normally supposed to do when an employee stops working is put them on COBRA. You can only put someone on COBRA if you terminate them. Our general belief, if you're going to have a job action for more than 30 days, is we would generally recommend a termination. You could still rehire someone after you terminate them. And obviously you communicate that to your employees that you intend to rehire them if work comes back the way it's supposed to be. You can still pay for their insurance if you want on a termination, because if you put someone on COBRA, you as an employer can pay for some of the COBRA cost or pay for all of it. And the employee this way still can contribute. It helps you with your cash flow. And then if you're going to give any pay continuation or any money towards benefits, you actually then potentially have the ability, if you want to have them sign a severance agreement, which obviously gives you litigation protection that if for some reason an employee were to pursue legal action against you, you're going to have a release from them. So that's a strategy we've been recommending with a lot of our clients, which is offer to pay for some or all their COBRA, even offer a little pay continuation if you want to, and then have them sign that release document to give you that extra protection.
Right. And one last question: if you furlough someone, they are eligible for unemployment, correct?
Absolutely, they are. They always have been, but there's been clarification on federal unemployment in the states that they will consider a full furlough for unemployment. Again, someone who's partially furloughed or even partially unemployed, decrease in hours, would be eligible in most states and in this area, but they only would get partial unemployment if they were partially furloughed or partially laid off.
Right. Does the state orders for stay-at-home qualify for the $511 a day under FFCRA?
No, it does not.
Great. If you have employees who are not working, but you have applied for PPP, do you keep paying them right now while you wait for the PPP?
I mean, you can, obviously.
You can, yeah.
Want to, but you don't need to while you're applying for the PPP. From an employer strategy, if you don't have the work, this is the time now to not pay them, to put them on a furlough or have them temporarily terminated before you get funded. One other date I think we mentioned quickly before was April 26th is a date you do need to keep in mind. Also, to give yourself full forgiveness. You're allowed to make any changes to your headcount until April 26th. After April 26th, if you furlough or terminate someone, it will be held against you in the forgiveness, as Carl mentioned before, decreasing the value of that calculation.
Right, that's an important date, everybody. April 26th.
April 26th.
Great.
A lot of magic dates flying around.
Yes, a lot of magic dates.
Yep.
Do the employees need to spend their own sick time or PTO before they can use FFCRA benefits?
No. FFCRA and even the New York State leave plan is both supposed to be in addition to that, and you don't need to exhaust any of your time to be eligible for that. And an employer cannot make an employee exhaust their time unless the employee wants to, above and beyond what they're getting through the FFCRA.
You recommend putting loan proceeds in a separate account?
I think so. So when you go for forgiveness, you're going to basically, as we call it, you're going to have to fill out a really big, bad, nasty expense report and prove out where every dollar went. So while funding's probably going to go right to your main operating account, we would recommend setting up a separate account, call it ABC Company PPP, fund the money there. Let the banks give you the audit trail with the bank statements. So as you need to fund payroll, you can transfer it. You'll have the dates. You'll know the amounts. You can pull your payrolls and back everything up from that point on. But the less work we could do and the more third-party cooperation we could get, like bank statements, the easier this is going to be to go for forgiveness.
Right. That's
I mean, our firm's policy, Carlo, is to tell everyone to set up separate accounts because we think it's critical. And the forgiveness portion of this is probably going to be very difficult. And like anything else, you want to have a trail, and that's probably the easiest trail to have.
I think that's an important thing. So a strong yes.
Absolutely.
Strong yes.
Would union benefits fall under approved expenses to be included in the grant equation?
Well, as Carl mentioned, sorry, Rob.
Yeah, that will include as far as payroll costs, just as it was in the loan calculation.
Right. If an employee has tested positive, but making more than the $511 a day that an FFCRA is offering, can they be combined with any of the other state PFL or DBL?
That's a good question. The reality is no. They, would go with, the precedent, which now the federal law is the precedent. So they would get the cap of the 511 a day, but that would be the most that they would be able to earn.
Got it. For FFCRA, can these be used for employees that may be able to work part-time from home, but are taking time to rest as they have tested positive?
Yes, it can. So that's an interesting component. So the New York one, when it was active, clearly stated that if you had the ability to work from home, that would supersede your ability to collect leave, even though if somebody contracted the virus, again, it was an argument that they weren't necessarily up to working during that time. The federal one does not have those same restrictions. So even if someone can work from home and is eligible for the 2 federal programs, they can take them even if they have working at home abilities.
Got it. Is forgiveness proportional to return to pre-CO COVID? Hold on a minute. Payroll count.
So I'm interpreting that to be if somebody were to bring back on less people at June 30th than one of their way station magic date periods they selected, is the decline in forgiveness proportionate? And the answer would be yes. If you bring back 10% less people than you were supposed to, you're not going to get the full forgiveness. We would have to do the allocation that way.
Great. And let's just, because a couple of people have asked, dates, are very critical in all of
Magic
this.
dates.
Magic dates. Let's go over the couple of targeted dates from now till the end of June. Because I see a bunch of those dates.
Yeah. So the first batch is to identify your employee headcount, right? So we have February 15th, 2019 to June 30th, 2019, or you could elect from January 1st, 2020 to February 29th, 2020 to establish your pre-COVID average full-time employee headcount. So when you go for forgiveness, you have to meet those numbers. And obviously, as Jeff and Robin said earlier, we want to go with the lower dates. The lower headcount, I'm sorry.
Yes, Carl, that's for forgiveness.
Yes.
Just explain the April 26th date again and the June 30th date, because I think that may be part of that.
Yeah, those 2 dates people seem to have a question about.
So
Yeah, just on the April 26th date and the June 30th date, the rehire dates, if you can just explain that again.
Oh, Carl, would you like me to take it?
Yeah, please. Oh, yeah.
Oh, yeah, no problem. Okay. So April 26th is an important date because you're allowed to make any changes from your employee count now until April 26th. So if you have 100 employees and you want to let go 20 more, you have until April 26th to do that without any penalty. If on May 1st, you let those 20 people go, that's going to be deducted out of the forgiveness calculation in the fact that you've gone past that period where you're allowed to make those changes. So there's multiple ways that, forgiveness would be taken away, and that is one of those dates. So again, we know a lot of people made changes by April 1st because of the FFCRA. That's another important date. April 1st was important because now anyone who's an active employee would be eligible for these leave programs and continue to be so. So April 1st was that date for FFCRA. April 26th is an important day, for you to make any more changes to that penalty. It still does not alleviate the fact that any changes you made before April 26th, those people, that head count, needs to be rehired by June 30th. We've mentioned the 8-week period of the loan. Obviously, that's going to be depending on when the loan is funded. We're assuming most people will get funded in the next 30 days, give or take a couple weeks. You don't have to have everybody back when the loan is funded, but again, it's going to be very difficult to use those loan proceeds and have up to 75% of it be used if you don't bring enough people back. Some of our clients are choosing to bring less people back and just understood that they're not going to have, part of that loan forgiven, and they're just going to use that as continued capital and be able to use what they can. You also remember you can use more than 75% of the loan on payroll costs. So you're not limited to that. You just have to use at least that. So there's some strategies. Do you hire more people? Do you give out additional compensation during those periods of time to people that are making under $100,000 to use those proceeds? So if you like to give bonuses to people during certain times of the year, that's a pretty good time to give somebody a bonus during those 8 weeks, because that will be money that you would eventually get forgiven. But again, it has to be with people that make under $100,000. There's still going to be some more regulations that are going to come out on the forgiveness. The Treasury and the SBA have mentioned that. We believe one of those regulations is going to be that you can't spend more than the percentage of that person's salary during that period, and it can't exceed $100,000. So if you have an employee that's making $50,000 salary, you could potentially give them some additional comp, but we believe the legislation is going to say it can't average more than $100,000, kind of divided by 12. That's something we're going to have to watch.
Yeah, and just to
And
bolt on.
I think clearly this is a rapidly changing.
Oh, yes, Carlo.
Yesterday or this morning, I heard that the feds are looking to infuse more money, more bonding capacity. I mean, the financial piece of this epidemic is changing daily. So are you guys updating your website, things like that?
Yes, we are, Carlo. We're updating it on a regular basis. We have certain sections of our website just dedicated to COVID-19, and we post additional information on it daily. As we speak right now, one of the things I wanted to tell everyone is clearly the dollars that were allocated to this portion of the $2 trillion CARES Act is clearly, they're going to blow through that amount, and they've gone for additional funding. And as we sit here now, obviously that additional funding, they thought was just going to be one vote and it was going to happen. That's not happening right now, which my fear is that as a result, in order to get the additional $250 billion, which they're clearly going to need, I think by Saturday, they go through $349 billion.
Wow.
But what'll happen is there's going to be more needed. And that's obviously held up in Washington right now, which is not a good sign. And again, getting back to my fear is that they're going to change all the provisions.
I agree. Well, one of the provisions we hope they change, and I'm speaking as an association executive, is a group like the New York Building Congress has staff who I will say are working harder than they've worked in forever, because they are constantly dealing with members, helping and working. We are not eligible as an organization to help our staff and keep people on payroll. So if you're 501c6, as you know,
Yes.
which are chambers of commerces all across America. As a former president of a chamber of commerce, I could tell you it is a struggle to keep payroll every 2 weeks. And as companies can't pay their bills or tell you, well, we'll pay our membership dues in September, or we'll give you money for events in the fall, you still have to keep people on payroll. So, we've been working hard with a lot of groups across the country to include 501c6s as part of the changes.
As you know, unfortunately, the act, when it came out, only had 501c3s and 501c9s.
Right.
Or veteran organizations. Those are the only two in the not-for-profit category that were included in the bill.
Right. Agreed. So we're working hard on that. To all my association execs out there, we're working on it. Couple more questions. Let's see. We have a lot of questions, so we may have to get them to you guys and then
Please
send back answers.
send whatever's unanswered to us. We'll draft responses and get out.
Great. if employees use the payroll tax benefit for company, can SBA loan amount you be used to pay their payroll during this time? And then can the company still benefit from the loan forgiveness of this amount? In other words, can you have a double benefit?
No,
I don't know that we really understand the question.
I think Lou,
That may be a
Lou, what they're
question.
talking about. I'm
Yeah.
sorry. I think
Yeah.
what they're talking about is the opportunity for deferring your payroll taxes. If you were to do
Yeah.
that within the act and go after forgiveness, you can't do both.
that's right.
Got it.
Right.
Okay.
Also,
I think
Carlo,
a couple people have asked, where will you be able to send out the PowerPoint? Because I think it was good. And I don't know the answer to this, but maybe George from my office does. Will we be able to replay this? A few people have asked, can we replay this? I am not a techie guy, so well.
I believe it's being recorded.
Yes, I see
That's-
recording.
That's
up top.
right. It's being recorded, and we're going to be publishing this video later with the rest of the webinar material.
Perfect.
And
Great
Carlo,
answer.
we have an expanded slide deck, which we'll put in everybody's hands that was on this webinar. That goes
Right.
into a lot of this detail. It's not just going to say, what we talked about. We don't want anybody to get distracted by reading slides. So, but we have an
Right.
expanded deck we'll put in everybody's hands.
Perfect. And Carl, can you send that over to us as well? And we'll
Absolutely, of
include
course.
it in our blast out there.
course.
So we've got about 2.5 minutes left.
Paul, I only wanted to say one thing. I just want to
Please.
let our fellow members of the Building Congress know that if they have any specific questions in the slide deck, our email addresses will be there. A number of the members know us, and tell them just to reach out to us, and we'll be more than happy to help people.
Right. And I will just end with this, and I don't remember who said it earlier. It is a question. Will construction look differently after this? Will people say, wow, we were able to work from home. We were able to do online college courses. We were able to shop online. I have an answer to that personally. My answer is no, because I believe that we are still a human race that needs interaction. We still need to sit together, learn together, talk together. And I know that this industry, and Lou, you started us off with this industry is the industry that gets America back to work. It may not be tomorrow, but in the coming weeks and months, the entire building industry, construction, engineering, design, architecture, accounting, legal, education, healthcare, all of us are going to get this country back to work. And we want to see each other. We want to hug each other. We want to have a drink together. We want to get back to the reality of the world we live in. Because technology is great and critical, obviously, but it doesn't replace that personal feeling. So we're going
Although I
get us
applaud
up
you
and
on what
running
you just
soon.
said. I applaud you on what you just said, and I will tell you that every Friday our firm has a virtual happy hour,
Nice.
and I will tell you that many of our people cannot wait to get back into the office because they want to be with their fellow employees, and there's human connectivity that is so critical to all of us. It's
I
part of
agree.
our core as human beings, and I couldn't agree more.
I agree. Well, on that note, happy Passover, happy Easter. We'll continue to work together, and really an applause to all of you for putting this together.
Thank you, Carlo.
Thank you.
Thank you. And
Carlo.
thank you to my team at the Building Congress for doing the technical part of this. Have a great day, everybody.
Thank you.
Thank you.
Thank you. Bye-bye.
Bye.